Chokkalingam, Executive Director and Chief Investment Officer at Centrum Wealth Management, joins in live on the show. Chokkalingam, thanks for chatting with us on ET. Now we're seeing a fair amount of strength in equity markets on the back of favorable political developments in New Delhi. What's your sense? From here on, what is it that could potentially take the markets to another high?
I firmly believe that from here the market can move anywhere around 10% by March 31st next year. The triggers could be, perhaps the passage of a banking bill, and that should be followed by a rate cut in the month of January, because IIP has been stagnating and industrial GDP is also pathetic now. We have brought down growth substantially. And also the December quarterly results would be good. It would be marginally better than the last year. And the government is very firm on the reforms. We saw yesterday the SARFAESI Act. That's a good move. It can help the banks to recover NPAs in a better way. So all these triggers should play out. And finally, with the rate cut, even the industrial GDP should start recovering. And therefore, I firmly believe that market is set for breaking the previous record of 21,000 on Sensex before March 31st.
Chokkalingam, what is it that you like out of the mid-cap PSU banking lot after the recent activity that we've seen in the entire space?
I like two mid-cap PSU banks because if you look at the PSU banks, there are many banks which have compromised on quality of assets but posted the better profit growth. So if I go by a balanced approach between the quality of assets and profit, I would recommend State Bank of Bikaner. This bank has come out with very good results for September. It's available below book value. Historically, it has been growing consistently. And on 1 year forward book value, it is available at around 25% discount. And also, it's a good dividend yield stock. It should give more than 3% yield. Second, I would bank on Jammu Kashmir Bank. It's a state PSU. It has run up around 35% in the last 3-4 months, but still, I firmly believe that there is a lot of upside in the stock. We continue to buy even today. For simple reason that net NPA is almost close to zero. It is just 0.16%, and it has been consistently growing its profits. And since the share price also crossed 1,000, there is a possibility of split or bonus to increase the liquidity. And the stock is available at around 1.1 time 1 year forward book value. So these are the two mid-cap, government-owned banks I would strongly recommend.
Within the auto pack, Chokkalingam, what would be a top pick? Would it be a Tata Motors or would you still prefer a Maruti to it?
I would prefer only Tata Motor in the entire auto pack. That's again because of their exposure to the global sales. On domestic front, the commercial vehicles are seeing in fact a 40-50% fall in the sales on year-on-year basis. And on domestic front also, I see a lot of turnaround starting from Jan-March quarter. As I said, we firmly expect the reversal of interest rate cycle, and within auto pack, commercial segment is highly sensitive to interest rate, and therefore from Jan quarter onwards, the domestic business also should turn profitable. And also considering the valuation of Tata Motor, which is available less than 7 PE, I would strongly recommend Tata Motor. On other auto majors, I would wait for another at least 5 to 10% correction, because on domestic front the numbers are not attractive. Today we saw November sales. The entire auto sector is growing at around 1% on year-on-year basis. So therefore it is better to wait for some correction for other auto companies.
Chokkalingam, what is it that you like out of the cement space, considering that too has held out pretty well in the last couple of trading sessions?
I think maybe only for traders the cement pack can be considered, because I firmly believe that some of the cement stocks are quoting at as high as 14-15 PE. If you go by the historical standard, at a bull run, they should not be quoting more than 10 PE. That will be the smart investment strategy to, track the cement companies. Considering the huge capacity build-up, I firmly believe that, it is better to pick up if there is any 5 to 10% correction. And in fact, one can look at mid-cap cement companies, which are attractively valued at anywhere around 5 to 6, 7 PE, rather than picking up the large cement company which are available at around 15 PE.
What about HUL, Chokkalingam, at 549? What would you advise investors to do with this one? Do you think they should now get out of this counter, or do you think there's room for more upside?
I will firmly suggest selling HUL. shifting money to ITC. Because if you look at ITC, it's available on at around 27 one-year forward PE, whereas HUL is more than 30 PE. If you look at last 3-4 years, ITC has narrowed the gap between the valuations of these two companies, and ITC is well diversified within FMCG. It also got a unique advantage of generating a lot of cash from cigarette business, which is almost price inelastic. And also the hotel business is doing very well, and it is surprisingly the most profitable hotel business it is running within the hotel industry. So considering all these factors, and also considering the fact that other FMCG should be positive in terms of profit accretion within next 1 or 2 quarters, so that itself will improve the valuation of ITC. So therefore I would suggest strongly selling HUL and putting money in ITC.